Namaste and welcome to a presentation on variance analysis of variable overheads. Under marginal costing, you are aware that we have got a concept of items which are variable and items which are fixed. And if you look into variable overheads along with direct expenses, direct labor, direct material, and sales, they are all related to volume of business. The idea behind talking about marginal costing here is to say elements of cost which are variable in nature, their variance analysis will follow a same pattern because it is based on the relationship of variability. Therefore, whatever way we analyze sales variance, material variance, labor variance will be continuing even with variable overheads. The formulae, the template, and the way we give names to them. And yes, there will be marginal differences in terms of terminology used. Just to have the overview, sales value variance, material cost variance, labor cost variance. Formula remains the same. It is variable overhead cost variance. Second, sales price variance, material price variance, labor rate variance, and variable overhead expenditure or rate variance. Either way we can call it, but formula remains the same. And taking the next variance is sales mix variance, material usage variance, labor efficiency variance. We can replicate labor template and it is overhead efficiency variance. We can see that the same variance names are repeated in respect of variable overheads, borrowing it from labor. And as we saw, sales mix variance is a combination of sales volume and sub-volume. Similarly, material usage variance is a combination of material mix and material yield. And labor efficiency, labor mix, and labor sub-efficiency, borrowing the terminology from labor, variable overhead mix and variable overhead sub-efficiency. It is replication of the header as available in labor. Therefore, variable overheads and labor go hand in hand when it comes to analysis. And we have these relationships as we have already seen. Rate variance plus efficiency variance is equal to variable overhead cost variance. Similarly, variable overhead efficiency variance has got two components, mix or gang sub-efficiency. When we add them together, that is equal to variable overhead efficiency variance. To sum up, variable overhead analysis strictly follows the way we do variance analysis in respect of labor, material, and sales. And second, it borrows the same nomenclature as is available in respect of labor. We have got a problem on variable overheads which appeared in June 2018. We can solve it most easiest way. We can get going. The following are details available for ABC Limited, a manufacturing company. It has got variable overheads. We are given absolute amounts. We are given output, budgeted as well as actual. We are given working hours. We are supposed to calculate three overheads which are specified. We can just take the things straight away. ABC Limited, it has got variable overheads. Budgeted expenses, budgeted amount is 5 lakhs. And when you say budgeted, it is standard hours into standard rate. There is no need to create one more thing. The amount which comes under SHSR is nothing but the budget. Standard hours into standard rate. And actual hours into actual rate is 5,20,000 is the actual expenses. Simple and straightforward. Output in units, we have got production units 50,000 under budget and 40,000 under actuals. Working hours, standard hours 2,50,000 and actual hours 2,20,000 we posted there. Now these are the inputs given which are made use of. SHSR is 5 lakhs. We know SH, we have to find out SR by SHSR divided by SH. Therefore, it is 5 lakhs divided by 2,50,000 is 2. Similarly, we have got AHAR 5,20,000. We have got actual hours 2,20,000 per hour. Actual is 2.36. Therefore, standard rate is 2. Actual rate is 2.36. That's it. Then comes the proration. We have got the same logic where it is not equal to each other. We use that and prorate it as the revised standard hours. 2,50,000 for 50,000 units. How much is for 40,000 revised standard hours? Standards revised for the actuals achieved is 2 lakhs. And once this is done, it is only a matter of RSH into SR, RSH SR. Similarly, AH into SR, AH SR. Now we have got all the 4 components RSHSR, SHSR, AHSR and AHAR ready with us. Simple straightforward solution. And that takes us to answering the questions. Variable overhead expenditure variance. Expenditure variance is also known as rate variance. We have to answer it in the same order. Rate variance is normally AHSR and AHAR, where hours are common. It is the rate difference, therefore variance arising out of rate on the actual quantity, and that is 5,20,000 minus 4,40,000. 80,000 is positive. When expense is positive, it is going up, it is adverse. Then second one, variable overhead efficiency variance. Point number 5. Efficiency variance is RSHSR minus AHSR, where standard rate is applied. Efficiency is due to the actual hours that are used. And when we see it, RSHSR 4 lakhs, AHSR 4,40,000. 4,40,000 minus 4 lakhs is 40,000. It is positive. Expense positive is expense increase, and therefore it is adverse. And the third one is total variance overhead is item number 1, which is variable overhead cost variance. That is the total. And as we know, total is RSHSR minus AHAR. And the total here is 5,20,000 minus 4 lakhs is 1,20,000. Means for the given output, the hours, the RSHSR should have been 4 lakhs, but we have incurred 5,20,000, means we have incurred 1,20,000 more. And plus in case of expenses is adverse. Now that sorts the issue. Just to brush up our memory, item number 2 means rate variance plus efficiency variance is equal to item number 1, cost variance. That is the relationship. Second, efficiency variance is due to mix and yield, that is variable overhead mix variance plus variable overhead sub-efficiency variance added together. It leads to variable overhead efficiency variance. This is just for the sake of refreshing our memory. Otherwise, the question asks us only 3 answers. That way, this is how we proceed to calculate the variances arising in a variable overhead. And hope you enjoyed the presentation. And this leaves us with only one aspect of fixed overheads, which we will be taking up in the ensuing presentation. Thank you so much. Thanks a lot.